John Higgins, Mortgage One. Happy Monday. So, quick recap on last week's data. We did get the Fed's favorite gauge of inflation, the PCE, that was released, and it came in at 2.5%, which shockingly or surprisingly, that's the lowest reading we've seen in the last 4 years. We know the Fed is targeting 2%. The last 12 months, we've been pretty consistent, under 3%, but getting to that 2% marker for the Fed has really been proven to be quite difficult. And why is that? Well, the Fed released their minutes from their last meeting at the beginning of May. And as you can see by some of the comments, that inflation could prove to be a bit more persistent, that the upside risk to inflation has risen, basically on the backs of all the tariff talk. We've got considerable uncertainty surrounding the trade policy, and when taken together, the Fed has, basically commented on the uncertainty about the economic outlook. And really, the Fed's two major plays in the market is trying to keep employment healthy and get to that 2% marker with regard to inflation. So, where does that leave us as far as interest rates go? We've got the 10-year Treasury that has broken back below 4.5%. That is the battle line that's been drawn. You can see in the middle of the week, we spiked again above 4.5%, but did finish nicely below that 4.5 number. And this morning, we've opened up at 4.43, so not too bad at the moment. What do we got upcoming for next week? Well, it's really all about the jobs market. So we've got the Fed's non-farm payroll number coming out. We have ADP's private sector employment, and then the JOLTS report, which shows the openings that are out there and the labor turnover. So we'll have 3 days of job reporting dates that will be big market movers. Right now, we don't expect the unemployment rate to move from its current level at 4.2%. The estimate for the creation of jobs is around 130,000. So we'll see how that comes in. We have had a very robust jobs market, which again, as we've discussed many times, is great for the real estate industry because we need people with jobs to buy homes, right? So where does that leave our interest rate environment at the end of last week? Well, the Freddie Mac survey came in at 6.89, and that is another tick up as we continue to push against 7%. Depending on your client's down payment, the program, and their credit score, we are seeing interest rates that are hovering right at that 7% threshold, depending on a few things on either side of that number. We'll give you an update next week after we get all of this jobs information. Until then, have a great week.